Markets seem to be taking economic good news as bad news.
Well, I think if you look at the US economic exceptionalism narrative, that has really had legs to run. You know, we expected a slowdown happening in the first half of this year. That timeline seems to be pushed out. We have had a string of very strong economic data coming out from the US. So even though we had Fed Chair Powell and a couple of other Fed speakers like Meister, basically essentially singing the same tune. They are saying that there will be rate cuts to come. It's just that there's no urgency yet. So markets kind of like looking past, you know, the Fed talk and thinking that, oh, what if the Fed doesn't really cut rates this year? I think that's going to throw a big spanner into the big risk rally that we've seen for a lot of risk assets this year.
And what if the Fed is actually behind the curve? What if the Fed gets surprised by economic data, which turns for the worse?
Well, I think there is a big risk of that happening. I mean, that's one of the key risks that we see in terms of the very benign scenario of a global soft landing scenario. I think the issue is that actually we still have a couple more of the inflation prints coming out from the US before the June FOMC itself. No one's really expecting anything to happen in May itself. And I think the base effects from last year, you are going to see quite a big drop in terms of the US inflation numbers. Effectively, I think that would open the door for the Fed to cut rates come June.
And Dan, good news is good news. We should be celebrating and not be depressed, despite the fact that perhaps the Fed needs to delay its first rate cut.
Yeah, there's a surplus of long faces, and it's almost a myopic view because it's focused primarily on the reaction to that ISM number. Cast your eyes beyond the United States, as important as that is, and you'll see some key global bellwethers starting to crank up. We've had some very strong export figures from South Korea. That is a vital node in the global supply chain. And we're also seeing some suggestion that activity has bottomed in China. The question is, are people really noticing? Have they become so thoroughly bearish on China that signs of a turn get discounted? Now, I agree with Selena. There's no suggestion, nor should there be, of panic at the Fed. Jay Powell's made it very clear they don't have to rush. The other thing which keeps being overlooked at is he has said a couple of times we are well into restrictive territory. Not just restrictive, but well into, which means policy can still be fairly tight even if they ease up a bit.
But this is a market that wants to keep believing that the rate cuts are coming, right? I mean, we've seen expectations go from 7 to 3, and perhaps even 2 now, and yet we're seeing S&P at close to record highs.
Yeah, so I think there is a couple of things that are driving. I mean, you look at the yield story. The longer the Fed stays at peak rates, that's going to favor the dollar, right? And so far, if you look around outside of the US, things look pretty soft at the moment. It's really only the US that is outperforming. And as long as that story continues in the interim, where would you put your money? I think it's quite a logical conclusion. People will still be looking towards the dollar. People will still be looking towards the US equity markets. But that's as long as the Fed sticks to its guns and say that rate cuts are coming.
What are you betting on? Where are 10-year yields headed? 435 right now.
Well, I think we are looking for a steeper curve. The 10-year yield is very much a reaction to, you know, where the real rates are. And as you said, Powell believes that we are well into restrictive territory. So if you look at the break-evens, you know, essentially at 2+%, it's still fairly restrictive. Even if they lower the rate a little bit, the Fed funds futures rate, it really doesn't move the dial that much. So I think the story really has to continue that not only will they just start to cut, but there will be a series of cuts that will be forthcoming second half of the year and going into 2025 itself.